Yeah, I mean, I think it's a good point, Jeff. I think this is just a sort of extension of the narratives that we've had, going into COVID and then the sort of the COVID emergencies and coming out. So we are in a huge fiscal environment for the next few years. We have that narrative about building back better. You heard him talk about environment and clean technologies and climate change. There is going to be huge fiscal spending going forward. And, if you sort of switch into the Lagarde comments as well, I mean, she was pretty dovish in the context of the non-taper taper. So I think bond yields are going to be very low for a significant amount of time.
But aren't bond yields meant to be reacting to inflationary pressures? And aren't we seeing with EU inflation data at 3% plus that there are reasons to be concerned here? I mean, what's the point of buying a bond that is generating a rate of return that is so much lower than the current headline inflation rate? It's just a slow boat to going poor very quickly, isn't it?
Yeah. So look, creating negative real yields is an implicit policy across the sort of the G10, if you like. I mean, the anecdote you've just given can be mirrored in the US as well. But look, a lot of this inflation isn't pernicious inflation. It is still transitory inflation. We still have significant demand and supply chain blockages, and the plumbing is still not working across the global economies. So what we've seen in the States, for example, headline and core inflation is beginning to ebb already, and we don't see significant pressure on real wages at this point. There are certain sectors, sort of opening up COVID sectors, that are experiencing some real wage pressure, but we still think that this is going to pass through the system. But negative real rates is here to stay for some time, and that has a significant impact on real assets. So where you get exposure to real assets, you're going to see asset inflation.
Good morning, Bill. Did you say asset inflation or asset bubbles? And I reiterated it earlier on the programme today, when I see junk bond yields trading significantly below inflation, whether it's transitory or real inflation, we'll leave that one part. But it is the CPI measure as Europe uses it. When junk bond yields are below inflation levels across Europe, don't even you guys think there's a little bit of a problem here?
Yeah, look, I mean, I think you're talking. I heard your piece earlier. You're talking about 2 to 3% on the high yield part of the US. Look, I mean, it is trading around neutral to negative real yields, and that is not the most compelling investment choice. But when you look at junk bonds or high yields, you're really looking at your risk premium to your sort of implied default rates. And the implied default rates in that price is going down to low single digits. So really the question is, do you feel there's enough stimulus and support in that part of the section of the economy to justify those levels of default rates? You are getting to the point where that price choice is a difficult one to make. So we've been moving out of US credit and looking at the high yield market in different parts of the world.
But Bill, okay, so markets are stunningly efficient at allocating capital to where they see value. The algorithms, the high frequency, and indeed, dare I say it, people like you, mere mortals. What parts of the market are mispriced at the moment, given the manipulation, because it is manipulation, by central banks globally? Whether you like to call it manipulation or you quantitative easing, call it what you like, they are contorting the market by their aggressive purchases, whether it's the 60-odd to 70% of ETFs, equity ETFs owned by the Bank of Japan, whether it's the bond market we just alluded to there, whether it's Italian 10-year paper at 0.6% for a country that has a debt to GDP this year, which will probably be 160%. What part of the market is not manipulated at the moment? And B, which value is there left in that market if it's not manipulated?
So, couple of things there. Unpack that. Look, we as the started to say, we're moving out of that sort of US credit story we just discussed. We've been moving into Chinese credit. If you look at the Chinese story, or what I would say the Asian high yield construct, that really feels like there's pockets of value there. Asian high yield, for example, is moving towards 10% in terms of absolute yield. Its sort of risk-adjusted spread is around 7%. There's a lot of stuff going on in the Asian high yield, which is actually quite compelling, because to the point about default rates, that's implying a default rate of nearly 20% in that market. That's just not going to happen. So there are pockets around the world that are less, in your words, manipulated and more sort of normalized. So I think it's a matter of shifting your portfolio around. The last thing I would say on the bond side, yeah, we are significantly underweight nominal and government bonds around the world. But whilst this policy is in place, which is a very much a pro-growth, pro-inflation policy for the economies, asset price inflation will continue to grow. So risky assets in this real yield environment, real assets will do well. So you should expect that big sort of equity markets like the US to continue to perform for the rest of the year.